Welcome to Talk Tickers. We cut through the noise of earnings calls to deliver the crucial insights you need.
Today, we're diving into TrustCo Bank recent earnings call.
Yeah, it looks like a story of, well, pretty solid growth and some interesting strategic moves. Let's get into it. Okay, so TrustCo reported a really strong first quarter for 2025. We saw growth in both their loan and their deposit portfolios.
Okay.
Their net income saw a significant increase compared to last year.
Right.
And importantly, key profitability metrics like earnings per share, return on average assets, ROE too, all showed substantial year-over-year growth.
And capital.
They're maintaining a robust capital position, and asset quality remains exceptionally strong, very low levels of non-performing loans.
Okay, let's unpack this a bit. Starting with deposits. It seems like they're pulling in more funds across the board.
Yeah, everything's up. Those low-cost core deposits, business accounts, even, interestingly, cannabis accounts.
And time deposits. Those also increased year over year. They're putting this down to a renewed focus on digital account opening and, well, strong customer relationships.
Right. And they made a point, didn't they, about funding their lending organically through these deposits. What's the significance there?
Well, it points to stability, and potentially a cost advantage. When a bank uses its own deposit base, it's generally less reliant on maybe more volatile or expensive funding sources.
Like borrowed money or brokered CDs.
Exactly. So having more control over funding costs can really help improve that net interest margin.
Which it seems to have done here. Okay, let's switch to lending. Commercial lending up 8%. That's over $300 million now.
Pretty healthy. And on the residential side, it looks like home equity products are really leading the charge.
Right. So overall, total loans are up over $100 million from Q1 last year.
Yeah. And that loan growth seems to be a big piece of that margin improvement we were just talking about.
So when you see both deposits and lending growing like this, what does that signal?
It generally suggests, positive underlying momentum. They're attracting funds and finding ways to deploy them.
Makes sense. And the strength in home equity is interesting. Maybe people with those low-rate mortgages.
Could be. Using home equity for, say, renovations without touching their main mortgage rate, it's a plausible scenario in this rate environment.
Definitely something to watch. And speaking of that net interest margin, or NI, it's now at 2.64%.
Yeah, that's up over 8% year over year and 20 basis points just in the last quarter.
So getting better returns on assets and seeing liability costs decrease. For our listeners, what does that kind of deny expansion usually mean?
It's a really critical sign, right? Shows how effectively they're managing their core business. When both sides yields up, costs down, move favorably, it often points to, strong management of their balance sheet relative to rates.
Absolutely. And this feeds right into profitability. Earnings per share up 27% to $0.75.
That's significant.
And ROA, return on average assets, and ROE, return on average equity, both also up 27% year over year, 0.93% and 8.49% respectively.
Yeah, those are the metrics investors really focus on. That kind of consistent, significant growth suggests these positive trends we're seeing elsewhere are hitting the bottom line. They're getting more efficient.
Their capital position looks strong too. Consolidated equity to assets is 10.85%. That's up 3% from last year.
And shareholders' equity is up 6% year over year.
Which supports that new share buyback program they announced, right? For 1 million shares.
Exactly. A strong capital base is like a safety net for a bank. Gives them a buffer, but also flexibility.
So the buyback suggests what? They feel they have excess capital.
Probably. Excess beyond what's needed for operations regulations. And maybe they see their stock as a good value, a way to boost shareholder value.
And despite growing loans, asset quality is holding up.
Impressively so.
Oh.
Non-performing loans to total loans stayed flat at a very low 0.37%.
Wow.
And they actually had a net recovery during the quarter.
So they collected more on old bad loans than they wrote off this quarter.
Precisely. It speaks volumes about their underwriting and risk management, especially while growing the loan book.
Okay. Net income for Q1 was $14.3 million.
Up 17.7% compared to Q1 last year. Underscores that positive trajectory.
And book value per share
ended the quarter at $36.16. That's up 6% year over year, reflecting that growing underlying company value.
Now, their provision for credit losses, the money set aside for potential future loan issues, was only $300,000. Seems kind of low given the loan growth.
It does seem low, yeah. But it likely reflects management's confidence in their current portfolio quality. It lines up with those low NPL numbers.
So they don't see big losses coming soon?
Apparently not. But, it's always something to keep an eye on. Economic conditions can shift.
True. Let's touch on wealth management. About $1.1 billion in assets under management there.
And the non-interest income from wealth and financial services fees, up a healthy 16.7%.
Making up over 42% of their non-interest income.
And crucially, most of that fee income is recurring. That's valuable.
Why is that so important, the recurring nature?
It provides a more stable, predictable revenue stream that isn't directly tied to interest rate swings. It diversifies their income, makes them less vulnerable. Strategic diversification.
Got it. Okay, expenses. Total non-interest expense, net of some property costs, was $26.3 million. That's up $1.4 million from last year.
Right, mainly driven by higher costs in salaries, benefits, equipment, professional services, that kind of thing.
But they expect total recurring non-interest expense for the year to be consistent with previous guidance.
Yeah, that's what they said. So while expenses are up this quarter, if they hold the line for the year, it suggests management feels they have costs under control.
Maybe some of that increases investment for growth, like tech or people.
Could be. The key is whether expenses keep rising faster than revenues going forward. Something to monitor.
Let's circle back to the loan portfolio details. Growth focused on residential mortgages and especially home equity loans.
Yeah, home equity was up a substantial 17.3% year over year. Commercial loans grew too, about 7.5%.
So those home equity products still seem really attractive. Probably that factor of accessing funds without disturbing low-rate primary mortgages.
Very likely.
Yeah.
And they mentioned keeping their mortgage rates competitive, quoting a base 30-year fix at 6.5%.
Yeah.
Trying to grab market share, perhaps?
Seems like it. Maybe sacrificing a little margin now for longer-term customer relationships and volume.
It's a classic balancing act.
Yeah.
Short-term profitability versus future growth potential.
And digging into asset quality again, those non-performing loans are low, stable, early delinquencies steady.
Yep, consistent picture. NPLs were $18.76 million at quarter end, basically flat quarter over quarter and year over year. Still just 0.37% of total loans.
And that net recovery was, what, $258,000?
Correct. Plus, their allowance for credit losses, that cushion is still solid at $50.6 million, gives them a coverage ratio of 2.7%.
So yeah, all signs point to a pretty healthy loan book right now.
Reinforces that narrative of good risk management, definitely.
What about the economic outlook? What did management say about their markets?
They described their main markets as generally stable and performing pretty well, particularly the Capital District, which they noted has a service-based economy.
Less volatile, maybe?
Perhaps. And even their Central Florida locations are apparently holding up quite well, which they contrasted a bit with some softness seen down in South Florida.
Interesting regional difference. And home prices.
Stable in their markets, they said. No big swings up or down observed.
How critical is that regional stability for a bank like TrustCo?
It's pretty important. A stable backdrop makes lending and planning, well, just easier and less risky compared to operating in more volatile areas. It can be a real advantage.
Okay, finally, that share repurchase program. Authorized for up to 5% of outstanding shares now. That's way up from the old 1% plan they never even executed.
Right. And management sounded much more committed this time, indicating a greater intention to actually do the full 5% buyback this year.
Suggests a stronger view on buybacks now.
Seems that way. And while they didn't give a specific target capital ratio, they were clear they'd still maintain a very strong capital position even after finishing it.
So what's the likely impact if they buy back 5% of their stock?
Well, several things. It reduces the share count, which can boost EPS. It signals management confidence. Returns capital to shareholders, and, sometimes a buyback of that size can create demand supporting the stock price.
Okay, that tees up our not financial advice segment nicely. Based on all this, here's an outrageous but plausible trade idea.
All right, let's hear it.
Given TrustCo's strong capital, and especially that stated intention to really execute this bigger 5% buyback, consider a long position in TrustCo Bank common stock.
Okay. The idea being the buyback itself creates demand.
Exactly. Could put a floor into the price, maybe even push it up. Now, obviously, there's broader market risk, especially for banks. So to hedge that, you could simultaneously buy some out-of-the-money put options on a regional bank ETF, maybe with a similar expiration date.
So protect against a sector downturn while trying to capture the TrustCo-specific buyback effect.
That's the thinking. Offers some potential downside protection. But of course, and we have to say this every time, this is purely hypothetical. Do your own homework, understand the risks, This is absolutely not financial advice.
Right. Okay, here's another angle, maybe a bit more indirect.
Yeah.
Thinking about what they said about Central Florida.
Yeah, holding up better than South Florida.
Right. And combine that with their own strong growth in home equity loans. You could look into, say, publicly traded companies or even REITs that have significant exposure specifically to that Central Florida housing market.
So playing the regional strength insight.
Kind of. Leveraging that specific comment from the call, again, totally speculative, requires a ton of your own research and risk assessment. Not advice.
Definitely not advice. Okay, that wraps up our deep dive into the TrustCo Bank Corp earnings call.
Yeah, we've hit the key financials, management's take on performance, and the economy.
And even thrown out a couple of, shall we say, creative trade ideas.
We hope this breakdown gave you some valuable context for your own thinking and your own investment decisions.
What were your key takeaways? We're thinking about what stood out most to you from this call.
Thanks for tuning in to Talk Tickers.
We'll be back soon with another earnings call analysis.